So I'm going to share with you today, over the next half hour, some of the findings of our new research with consumers about advice. Now, when I'm talking about advice, do not assume I'm talking about advice through a regulatory definition. I'm talking about what help people want, about what questions they have, which of course may fall into what we would think of as content, guidance or advice. But really I'm using advice throughout this webinar in its broadest sense. So sort of jumping straight into it, this is all of the content in the spanking new report which we published today. Great excitement, everybody. And the research sources, importantly, is quant research with 2,000 fund investors. So the more engaged, the savvier end of the consumer audience out there. We also have a lot of nationally representative stuff where we sort of ask people about their sentiments about advice, where they might seek that. And also we've supplemented it with some really deep dive interviews with our audience who are investors, and some of them, of course, get traditional financial advice, others are avid DIY investors. And then we've also checked in with the industry and what people are up to. So that's the sort of genesis of the content for our advice report I'm sharing with you now. So just jumping in and doing a sort of very top line, I always like getting it clear in my mind, well, who are we talking about? So if we look at people in the UK who have some sort of an investment product, that's either a personal pension or an investment product. That doesn't just include workplace pensions, they're more the accidental investors. These are people who have taken out or actively sought to do something with an investment or a pension. And of those, you can see that 3.5 million tell us that they have a financial advisor, which leaves 11 million people doing it alone. And then we sort of broken down the wealth, or how is that actually managed, and where, and what is the role of platforms in managing this wealth. And you can see, despite the larger numbers in the DIY audience, the collective amount of money that is managed on platform for them is approximately half the amount we see on the advised platforms. And across the board, really, you can see sort of concentration in both platform markets. One thing I'm going to touch on in this webinar I think is interesting is satisfaction levels. In the main, for an industry that's got such a sort of poor reputation, one might say, but with current customers, satisfaction levels are high. 90% there who see a financial advisor are very or fairly satisfied. And when we collect on our website ratings and reviews of those DIY platforms, again, there's an average recommend score relatively high there of 7.3 out of 10. So jumping into some more of those stats, now 9% of British people use a financial advisor. And actually it strikes me, before we sort of jump on, I don't think we can be complacent about that. You know, 1 person in 10 sees a financial advisor. What are the rest of us doing? We know that about half the population have investments or cash savings, but just 9% are seeing a financial advisor. And now if we look at that through the lens of people who have investment products, about a quarter of them are seeing a financial advisor. So 3/4 of people are wading through this maze on their own. Now, what's the difference between the DIY brigade and those who see a financial advisor? Of course, there's a massive sort of age gap, as you'd expect. The average age of an advised customer is 61, okay? And the majority of the wealth, of course, sits with that audience. Account sizes 2.5 times on average larger than with the DIY investor. So there's a really sort of clear picture of who is getting traditional financial advice. Not many, 9%. Average age is 61. We know that the majority of advised customers are also over 65. So some really sort of interesting splits in audience there. I'm going to talk a little bit more about the perceptions of value in financial advice. That's a question we get quite a lot from the industry. What is it that people really value? How do we crystallize this, and what is it? And I'm going to talk on that a bit more. But it's interesting, it's mostly softer metrics. People don't tend to come up with numbers or tax planning. They tend to talk very much about trust and relationships, and in fact outsourcing effectively the responsibility that comes with managing money. So let's look a little bit about how things have moved on. And this research was largely done after lockdown and, of course, after sort of falls in the market. And I'll touch on that as we go. But when we talk to people in the roundabout advice, and as I've said, forget our regulatory definitions, when we just ask consumers, where would you go for financial advice? There's a big difference in responses from people who have investments and from people who don't have investments. And you can see, unsurprisingly, that the sort of top recall for investors there, where they would go, is an independent financial advisor. But next up's a comparison website, which is interesting. And then third, their family or friends. And just as an aside, it always strikes me how people disregard the family or friends bit. When we see research like this that's published, the industry tends to just go, oh, that's silly, isn't it? And disregards it. But I think that all, of course, then feeds through into what we'll talk about a bit later, rules of thumb or people like you, which is where I think some of the more interesting developments can happen within the current regulatory framework that we have today. Just one stat I'll pull out there for the nationally representative audience, where would you go for financial advice? You can see there my main bank is cited by 31% of people. And I think that sort of highlights for me one of the main questions of my career, I think, that I haven't quite seen anyone crack and that sort of bugs me. On paper, the business case for banks is so great, and it's where people consistently tell us they want to go. And yet, as we'll see, the very early sort of advice forays this time around by the banks have not been broadly adopted. So the exam question, of course, is why? So 90% of people say they are satisfied with their financial advisor, which is astonishingly high. And then we dug in, well, why is this? Why are you satisfied? What is it that they do that you like? And it's those softer metrics I mentioned earlier. It's very much about communication. It's really interesting that sort of listen is tabled a lot, as well as people just talking and advising. It's that sense that someone's listening to your particular needs, that personal touch. Availability, I'll talk to that a little bit later, and that the trusted relationship that has been built up. And we have seen a slight shift since lockdown as well, about sort of reassurance and guidance. And almost from those people who've had financial advice for many years, they kind of know that most advisors are likely to say, sit tight, don't do anything, keep calm and carry on. But they just want that validation and that sense of reassurance. But communication's so key, and we'll dig into some more detail about video conferencing. We've got some stats on adoption there. What has been surprising to us, though, is finding out that a quarter of people have had no contact at all since the end of March, which seems extraordinary to us. And there's a lot of comments from people to sort of reinforce that and to flesh out the details of why. One thing we've seen as well is video conferencing has doubled, as you'd expect there. And we'll share some stats in a second to talk about how people think they want to get financial advice moving forward, and what role video conferencing plays in that. The volatility we've seen, interestingly, has not been a massive catalyst for people who are currently not advised to rush out and seek financial advice. Now, I would have thought this had been bigger, but just 9% of people who aren't advised today have said they are planning or considering getting financial advice. And of course, those who cite why they are, I mean, typically the word confused comes up the entire time, and the complexity of the industry. People who don't get advice or who don't want to get to advice tend to cite either costs and charges as a barrier, or a belief that they'll be able to achieve similar outcomes themselves without an advisor. And then, of course, we sort of have a lot in the report about, well, what's the role of robo-advice? How does digital play into this? And as we've seen with robo-advice Mark 1, again, sort of slightly limited and muted uptake from people, and people still across the board, unanimously almost say that they want some sort of human input throughout the journey. And again, it's not tested. I think that interesting comment there. I want some long-term stats to prove it's successful. And of course, we simply have to wait to get long track records and those long-term stats. There's nothing that any new robo-advisor can do really to counter that sort of suspicion out there. That's of course why average account size is still so low on robo-advisors, because lots of people just test it out and stick a toe in the water. But skepticism remaining still about digital advice, or as that lady called it, I love this, robot advice. Now, video conferencing, I think this is really key. We're not the only sort of group to observe this, but it's interesting to actually get a stat there that 51% of investors say they feel more positive about using this to communicate with a financial advisor. And actually what was really telling for me when I read all the verbatims from the sort of detailed interviews, and there were hundreds of them, was the amount of times in a questionnaire and an interview about financial advice that the word travel and park came up. So people actually now really sort of saying for the ongoing communication, for busy people, typically actually sort of more prevalent in those still working, of course, the time pressures are more, people saying, yeah, video conferencing, fine, but still very much a preference, as you would expect, at the early stages of the relationship, or perhaps that initial sort of fact-find stage, for that to be done on a face-to-face basis. So just thinking a little bit about what's available from a provider point of view in the market today. And this is just my crude diagram. And before everyone gets outraged, it's not every brand included on there. And of course, as always, definitions are tricky. So some of these people are providers, some of them are listed by type of advice. But bear with me, it's just sort of painting a picture of the choices that customers have when they look for advice, little a advice, with their money today. And we start at the sort of left-hand side there with the comparison sites. And I'll just remind you, before we dismiss this out of hand, that 34% of investors, so that's not even a NatRep number, but that's of the sort of savvier, more engaged investors, a comparison site was the second most popular after a financial advisor. Sorry, financial advisors, I know you won't like being talked about in the same breath, but 34% of investors said, that's where I would go to get, in their words, advice on money and how to manage it. And of course, the reality when you go there, particularly looking at the pensions, well, there's nothing effectively. And for investments, it feels to me very much as though it's still pay to play. And so these are little more than directories at the moment. Of course, there's the issue of brand taint. Lovely Martin, who saves us all that money every week, it's going to be slightly difficult if lovely Martin told me to go and open a stocks and shares ISA that's fallen by 20%. So I think a sort of issue there for them. But I enjoyed putting this together. I enjoyed making the Boring Money brand cheekily a little bit larger than Money Savings Expert. I have to get my kicks where I can in lockdown. Moving to the life companies, I've highlighted some of the main players there. Standard Life's new robo-advice proposition, which is live. It's devilishly hard to find at the moment on their website, but I think it looks really good. It's by far the best I've seen from any life company out there. And they've interestingly sort of really woven the humans into that process very effectively. And you can book appointments with people, and it feels very much as though it's an online experience that's reinforced with a human experience too. So I think that's interesting. It's early days for that proposition, but it looks good to me. The DIY platforms, of course, struggling still with those parameters between guidance and can we nudge people and can we say to people things like, gosh, do you want to have 50% of your pension sitting in cash? Is that intentional? Some of those are slightly easier to navigate. The fund selection piece, of course, the Bête Noire, Hargreaves, Lansdowne and Woodford, ... I don't need to say any more on that. But we know that people want best buys lists. 75% of investors use them, although interestingly, just 25% of those say that they rely on them, the majority using them for validation only, but a really key role. And we know that the single biggest category of question that non-advised investors have is which funds should I buy, which funds should I pick? And there's a really pressing need there, I think, that there's no satisfactory solutions for, no very robust solutions out there at the moment. I split robo-advisors and digital advisors. Robo-advisors typically lead to a product solution to an investment portfolio. Again, I think lots of groups, Nutmeg in particular, have experimented with how you introduce a human into that process rather than making it solely online. But work in progress and a much more muted customer uptake than one might have forecast 5 years ago when it was still a very nascent idea. I think more interesting is the new breed of digital advisors, which have a more holistic view and typically talk about insurance and other financial products, as well as investments and pensions. Particularly interesting, I think, is Maeva from Wealth Wizards, which is serving the workplace audience. And to me, that feels like a very natural channel to explore and for this digital advice to play out in. When we come to the banks, the problem children's, they should have a role in helping people. And I know this is controversial. I reviewed one of the robo-advisor propositions from a bank online, and I put some stuff on Twitter. It was Santander's journey, and the actual onboarding process and the risk profiling was well done. And at the end of the process, from memory, I paid about £20 for my suitability report. And for 20 quid, I have to say, I think it was extremely robust and thorough and well done, and asked all the right questions and tabled all of the right points. And I went online and I was on Twitter and sort of said, I quite like this journey. And there's a couple of advisors that I think of, like the grumpy old men from the Muppet Show, who sort of sit up in their balcony, and every time you say anything about digital advice, mumble and groan and grumble. But the point is, that costs £20. And I go back to thinking about the advice gap and the 11 million people who don't see a financial advisor and who have investment or pension products and who in the main need help. And I think, where is that help going to come from? We have to start embracing these alternative models, I think, rather than simply trying to throw stones at them. Financial coaching, interesting part of the landscape, devilishly difficult to do at scale, I suggest. And then the full of financial, traditional financial advisor model. I only put 2 brands in there. Of course, there are many, many more I haven't that are very wonderful businesses. So that's a bit of the advice continuum. I've used my consultants type word there. More details in the report. Opportunities, I think when I look at the robo-advisors, it's tough. I do think how we think about the workplace audience is an area for me which is really interesting to explore. The banks, I've talked about them a wee bit. I think they should be able to crack it. To my mind, it's the language up front. It's how they articulate risk to that cash saver audience. Risk is a 4-letter word. Risk only has bad outcomes. We can't simply slap multi-asset labels and pick 5 adjectives and plonk that down as a good articulation of risk. Life companies, some interesting evolution there, and I've pulled out Standard Life, which I think is, a good solution for many people. And I've just put with advice firms A Tale of Two Cities. We've interviewed quite a lot of advice firms for this report. Gosh, a real split between those who have adopted digital, who have their clients with access to online valuations and top-ups, in some cases open banking, and those who are still very paper-based, who have resisted the move perhaps for their clients to go online. And I think that, obviously will need to change and be addressed. And we see a real gulf across the board. Now, most people, in fact, pretty much everyone is reporting that new business, new customers are very, very sort of flat and low at the moment. But actually those businesses, the more digitally enabled ones, are still seeing good flows and good top-ups, etc., from existing customers. So a real, I'll use another consultant's word, bifurcation in the advice market. Just some closing comments then. We've interviewed people across the board, across the industry, about what they're seeing, comments on how they would like to be able to help clients more. Perhaps do we need to re-examine? I think we always need to re-examine the regulatory framework. And there is an appetite from people to be able to provide more directional guidance. Lots of people pulling out the people like you. Lots of sort of people talking about rules of thumb and how we can help people more there. Some change and sort of shifts post-COVID, the FCA sort of coming out to groups and being clear on what they can say to customers phoning up when they see their account balances slump. But I think generally across the board, people are sort of saying, how can we give more information, more directional guidance to firms? And that's what I hear across the board is what people are struggling with. Opportunities, lots of discussion in the press about, wet signatures, which feel anachronistic, video communications and how that's embedded into the advice process moving forward, and customers, as I've talked about. Someone made a very interesting observation to me. If you only get a quarterly report and bang, you open that quarterly report and the value of your investments has fallen by 20%, that is a very immediate shock. And that leads then to immediate need for feedback and phone calls and input. Whereas if people have this online access, they can at least see the progression and see the movement. And in some cases, of course, we'll have seen markets recover marginally to some degree since the initial falls. So, obviously, a move to a better digital experience across the board is key. A final observation on how I think we can help is really segmenting the questions people have. We are all terrible at talking to people about ISAs or about retirement as if their needs are one and the same. If we split, as we have done here, for example, the questions we have researched for this report into 3 buckets here: people saving up, that's the under 50s, the 50 to 65 nearing retirement, and those in drawdown. And of course, the questions are so different. So, why not map your comms and your articles and the content for your sites to your audiences, and why not map it all to these specific questions and needs, rather than sort of sit in your home office and try and second guess what it is that people want to know. Interestingly, I'll pull out on the drawdown side, maximizing income. That's a huge question for fund managers moving forward, is what's going to happen to the equity income fund. Discuss, and we're doing more research on that with consumers in the coming month. But a lot in the report about mapping and segmenting sort of customers and pulling out their questions, which I think is the obvious framework for a content and a marketing plan to hang off. So those are some observations from me. There's a lot in the report, and we've sort of covered that continuum from the DIY brigade to an advised audience. Do come and talk to us if you'd like any more information, but it's been super interesting to try and think about how changes we'd already seen in the advice world are going to be accelerated in part by the experience of the last few months, but also trying very hard to always think about advice in terms of what questions does the customer have, what do they need to know. And actually, I think a key takeout for me is there's a lot more we can all do within the current regulatory framework and with content to do a much better job of addressing at least 50% of the questions that people out there have. That's it from me. It's 12:30 on the dot. I shall leave you to your lunch hours. My children have managed to be silent 30 full minutes for the first time in God knows how long. So I shall go and reward them with crisps and pizza for lunch. Thank you very much for tuning in. I hope that was of some interest and use. Bye-bye.